Hello, fellow real estate enthusiasts. I'm Richard Montano, your host of The Loudest Silent Partner, the ultimate podcast for savvy investors who want to diversify their portfolio with passive investment opportunities. Join me as we unravel the secrets of successful real estate investing, where knowledge meets profit. Whether you're a seasoned pro or just starting, we've got insights, news, and inspiring stories you need. Let's turn the page on your real estate investment journey together. This is The Loudest Silent Partner, where your investments speak volumes. All right, we have Travis Goff here. Thanks for coming back and doing another podcast with us. This is you're just an amazing person, and I love having you as a guest on the show. I want to dig more into like what you're doing today. You know, we've talked about your past. We've talked about some of the other projects you've done, which you've done some really cool stuff with. You know, Impact Fund and Rooted. You know, buying single family homes and turning those into sober living units and renting those to organizations that focus on that. So you've done that, and now you're moving into launching a new fund with fixated capital, and you're going to be buying single family homes, flipping them. Some will be rentals. So I want to dive into that a little bit with you, and just how you took your lessons learned from your past works that we've discussed in the past, and how you're now applying those to this new fund. So yeah, tell us all about it, man.
Yeah, we're excited to be launching Fixated Capital here in the next month or two with my partner Tarl Yarber, and Mason Krell is our other partner. But Tarl was kind of the foundation around this, because he's known for being a very systems oriented person, and he's scaled a flipping organization. He did over 650 flips in the Seattle, Tacoma area, and was very successful through that. But he'll tell anyone he wishes he would have kept all of them. And so it's funny, now he's started kind of a group called Flippers Anonymous for local operators who are flipping properties, and they're chasing that paycheck, and it's very different when you're flipping properties versus buying real estate for investment. One is, it's a very active, it's just like a job.
Yeah, it's a full-time job.
You're making money this month, but you got to keep doing the deal to make money for the next month. And now we're taking all of the skills that him and I and Mason have done in our past, and we're putting it all together through Fixated Capital, because we're still buying distressed properties, but this time, he did it in Seattle, Tacoma, because that was where he lived, and that was kind of where he built the team. And I've had quite a bit of experience in investing in a bunch of different states and being an out-of-state investor. But what we're doing now is we're going out and we're picking a select couple markets where we feel we can generate the highest returns, both on the equity side, but also on the rental side of it. And so we've identified a couple early markets that we're investing in. But the idea here is we're buying heavily distressed properties. We're doing the rehab on them, but we're going to keep the best rentals long term, and then we're going to flip the rest. Not that they're not as good. It's just it's the better opportunity is to flip it and then reuse that capital to then buy more assets.
Yep.
And with this fund, we're with the current market, high interest rates, and where competition is at, we're going to be going in with all cash. So where in the past it's always been with at least the stuff that I've done, it's always been high leverage. Let's get mortgages. Let's, if we can over time, let's cash out and pull out all of our cash and then reinvest. This one, we're going in all cash. We don't have to deal with interest rates or anything there. And so it's going to be more of a conservative fund. We're not going to be chasing the highest returns for investors, but it's going to be very conservative, and we call it an equity and growth fund.
Yeah. You guys are pivoting with the market. I mean, right now the high interest rate market is just really difficult to get in anything with long-term debt.
Yep.
Love it. So when you do that, you guys are obviously limited with capital. What is there a set price point that you're focusing on with those single family homes around the state? Is there like a cap? Because right now we're recording here in San Diego.
Yeah.
And I mean, houses are really crazy, and with prices right now. And I don't know, like flips, they make sense. If you buy it right, they can make sense. And but rentals, I don't know of any that I've recently seen that makes sense. So where you don't have to necessarily say where, but like what sort of price points are you looking at?
Yeah, so that's a really good point. Depending on the market, I mean, the rent to price ratio, which is basically whatever the price of the asset is compared to the monthly market rent. You're not going to see a strong ratio in markets like San Diego because you're going to see more of an appreciation. Like if you're going to buy a property in San Diego, you're probably not going to be able to get its cash flow, but it should appreciate over time. It's more of a cyclical market rather than a linear market. For us, we're going into these higher. We're forcing the equity through the rehab, but then we're getting the appreciation or the income off of the rental. And I'm happy to talk about the markets that we're investing in. So we're launching in Savannah, Georgia, and then also Northwest Arkansas.
Okay.
Two very different markets, but we've seen strong metrics in both of those areas, strong employment. Net migration into those areas. Rent to price ratios are high because of that. And so Savannah, we're looking in we've already started buying there, and we're in the low 100,000s, and the ARV is in the mid threes.
Oh my gosh.
So,
and what are rents there for those?
They're in the low to mid 2000s for those types of.
Wow.
Yeah.
Those ratios are big.
Yeah.
I mean, here we're seeing like $3,000 to $4,000 for like a $1.5 million house.
Yeah.
Right. I mean, that's wow.
Yeah. So big difference. And same with Northwest Arkansas, but there the ratios aren't as good as Savannah. Savannah's really pushing right now. There's a lot of employment growth. But it's still really strong, and we just believe in it as an equity play long term because and that one's going to be a little bit higher on the price point. So we're looking in the $400,000 to $600,000 range.
And so for those, is there sort of like a threshold that you guys have defined that takes you from keeping it as a rental or selling it? Like, is there a rate of return that you're looking for? Is it how much equity am I going to get from this flip? Or, how do you guys decide, and I know it's not an exact science always, but I know you guys have good systems. So like where's sort of your threshold there?
Yeah. So there's two, there's a lot of different data points that we look at, but there's two, we've tried to simplify it as much as we can to just two data points. And on the flip side, we want to, because we're analyzing it both as a rental or as a flip on every deal. And on the flip side, the minimum threshold that we're looking for is a 15% cash on cash return. Okay. That's not using any debt. So there's no interest costs in that, but we're factoring in it in everything else, including closing costs, broker fees, all that. 15% cash on cash is kind of our base metric for what we're looking for. On the flip side, we're going to try not to have to sell it, but if we do, that's how much margin we want to make in equity. On the rental side, we're going off of cap rate, and the cap rate that we're shooting for is 8%. That doesn't mean that we're going to only keep it if it hits 8%. We're going to look at that neighborhood and see like if this is a high growth market, if it's in the path of growth and appreciation, then we'll push that down to 7% or in that area. But our target is around 8% cap rate, and the cap rate that when we calculate it is not off of market value. It's what our all-in cost is. So say we buy a property for $150,000, we put $100,000 into it. We're in it for $250, but it might be worth $320 at that point. We're not basing that cap rate off of $320. We're basing it on the $250.
Right.
Yeah.
Okay. And so if the metrics are even, like say that the rental is 8 cap and the ROI on a flip is 15%, then what? Do you keep? Do you flip? Like which one wins?
So we're always going to lean towards keeping it.
Okay.
So we definitely want to keep as many properties as we can. Flipping, it's great. We can, take those returns and we can either distribute or we can reinvest some of those to juice the returns long term. But our goal is to acquire and stabilize as many assets as we can, and then add some of those flip profits in to help boost returns a little bit.
Yep.
But the idea is, we're already generating equity. We're buying all cash, so we're already getting aggressive on our offers. So hopefully we're buying under market value on all these distressed assets. But then we're also forcing the appreciation with the rehab as well.
Right. So now, looking at investment wise, this is two questions. One is, are you guys structured as a pass-through entity for your investors in the fund? And then secondly, if you are a pass-through, are you guys maximizing like depreciation and those types of things? Because as a flip, you can't do that. But as a hold, you get those benefits. So like, how are you guys handling that?
Yep. It's passed through. So the investors will have equity ownership in the assets, just as if they owned it themselves. But yeah, with the structure of it, obviously, if it's a flip, it's active income. And so there's not really a way to avoid that. And because of that, we really have to distribute capital. We can't just reinvest all of the profits, because then our LPs would get hit with a tax payment and not receive any cash to pay for that. So our intention is probably to distribute about 50% of the profit, of the flip profits, and then reinvest the other.
Yeah. So when we had our flip fund back, years ago, we were structured very similarly. Looking back on it, and I've never verified or validated this, but are you able to do an exchange, a 1031 exchange, if you were flipping a property and say you made, $100,000 on a $200,000 investment, so now you're at 3.
Yeah.
Are you able to do that exchange? I forget if and maybe we don't have the answer here, but because it's an active operating business and you do more than 3 a year.
Yeah.
Right. Actually, hopefully more than 3 a month. Does that allow you to, or disallow you to do an exchange? So
in order to do the 1031 exchange, you have to own the asset for at least 12 months, which, I feel like we're not doing our job well if we have any asset that isn't either rented or sold in 12 months.
Right.
We're not looking to do any projects that are, above and beyond. We want cookie cutter houses that are, the same as a lot of other houses in the area. We're not going for, this huge property that is very different than everything else in the market that's gonna be really hard to sell. So everything should be, pretty fast volume with the rehab, easy to sell, easy to rent. But to do the 1031 exchange, one, you got to keep the asset for at least a year, and you have to have the intention of renting it. So technically, if it goes over 12 months, you could say, all right, I'm going to try to rent it. If you can't rent it for a month or so, then you could sell it and you could do a 1031 exchange. But I just don't see that happening with us. It could happen where, we stabilize a property, we do rent it for a period of time, but then we decide that we can, it's gone up a bunch in value, and we can transfer, that equity into 2 more properties.
Yeah.
And so that might be an opportunity that we do down the road, but that wouldn't be like our plan A.
Right. So that brings me to the next question about your new fund. Are you guys, what's the horizon on this? Is it 5 years? Is it 10 years?
Yeah.
What's the plan there?
So this is Fund 1. We're launching this with a $10 million raise. So relatively small, especially since we're using all cash. So we're gonna go through it relatively fast. This is kind of a proof of concept with this new structure. But we have a couple basic fees like any fund. So we have an asset management fee and an acquisition fee. That's how we make money on the front end for what we're doing. But in this scenario, we're actually giving 100% of the cash flow on the stabilized portfolio to the LPs until they hit at least a 10% return, or they get all of their money back.
Okay.
So the idea is we buy all these properties, we stabilize them, we have all this equity that we've gained through the rehab, and then now 3-4 years out, depending on interest rates, when those come down or the asset prices go up, we do a cash out refinance for the whole portfolio, and we pay back most, if not all, of the money to the investors. Now they've gotten all their money out of it, but they still retain their ownership in the assets, and there's no end duration. So as long as we own those properties, they'll continue to get cash flow checks out of it.
Got it. So this could be 10, 15,
Yep.
20 years. And so once you hit that $10 million mark, you're going to close that fund. And then this is a question, I'm saying it like a statement, but are you going to close the fund and then start a new fund and do kind of like the same thing or similar?
Yep. Yeah. I mean, 10 million is pretty small for a cash fund like this. So we should be able to go through it pretty quick. Like I said, this is proof of concept. This is, let's get this rolling. Let's make sure we like the structure. And we feel like we've made it pretty competitive on this first one for the investors. So they should be, hopefully we perform well and we do good on the returns. And then we'll be able to raise a lot more capital for Fund 2. Yeah. Fund 2 will probably be between 30 and 50 million.
Yeah, you would step up and just grow and get bigger. What are the return expectations that you guys are estimating with this? I know you said you're going to do like get them to 10% before you guys actually start to do a profit share, but what are you kind of thinking? And I know this is an estimate. You've got your numbers and your performas. Yeah. What are you guys thinking for the investors on this deal?
Yeah. So before we do the cash out refinance and pay back their money, we're looking at probably between an 8 to 10% cash on cash return. So it's not going to be, the highest return for funds out there. And that's not what we're going after. We're going after a conservative fund where you're getting decent cash flow, but you're also getting a chunk of equity that we're forcing into this through the rehab. And we're acquiring a solid portfolio of properties in markets that we've hand selected that we believe are going to, outperform other areas of the country. Yeah. And so that's the structure for it. 8 to 10% is, for a lot of people, this is a solid, investment that it's not going to deviate a whole lot from that. It's not going to, really underperform or, perform way higher because we're not using leverage. Right. And, in this environment, a lot can happen with the Fed and interest rates, and those are big variables. Yep. Without using that leverage, we can be fairly consistent. Yeah. I really like that. So if you guys are doing 8 to 10%, and you guys are getting your fees and stuff like that, so 2-3 years, you guys are just operating like normal operations. And how do you plan on getting those rents up to a point where that's going to be higher than the 10% so that you guys can actually earn or generate from that? What's that value add plan that gets you there over that? I think you mentioned 2-3 years. Yeah. I mean, we're doing the value add on the front end. So like we're going to be hitting, solid rental numbers, and then it's just going to be up to the market after that. Obviously we're picking areas where we're seeing net migration in and growth. So they should have, annual, growth metrics for rental rates, but it's gonna be more of when we do the cash out. At that point, that's when we'll be able to, the returns will be a lot higher. Yeah. And then we'll be able to start getting those splits. But for us, it's more about an equity play. Yeah. We're gonna own equity in these assets. We'll have, a chunk of equity sitting there from the appreciation that we put in. It's not a short-term deal for us. Right. So. Yeah, so we've done similar funds, and we get some of those clients, those investors who come in and say, "Oh, 8 to 10% doesn't sound like enough." Yeah. I think it's solid. Like that's something I would invest in. Like because that's all pre-tax, right? That's 8-10% pre-tax. So that's not including any of the write-offs, the depreciation of those things. Correct. Are you guys going to do any sort of accelerated depreciation, or are you just going to go to straight line? It depends. We'll probably just go, the standard depreciation schedule. But that's something that we're still considering. Yeah. Yeah. Cause that to me, that's one of those things where I love getting a negative K1, right? Yeah. I've got the cash flow. Yep. And then you've got, the massive depreciation, and now I get like a negative K1 at the end of the year. Yeah. I can offset with my other income. So that's always a really great thing. Going back to that, some of those investors who are like, that's not enough.
I typically stop conversations with certain investors because it's like, I don't need to like try to convince you to have a good time. But you know, it's hard because I think there's so many stories out there of like people who are getting massive returns, right? It's like I jokingly kind of related to that person who comes back from Vegas and they're like, I won $2,000 in the craps table. And it's like, how much did you lose before that? They don't talk about that. Right. And so there's these investors who see these people making all this money in these real estate deals, but they don't see the other side where they're making moderate returns or losing money. Yeah. And so how do you deal with investors who come to you, you know, when you're pitching or, you know, having these conversations? How do you what's your method of having that conversation with them?
Yeah, I think for anyone, especially, you know, more seasoned investors, they're not investing in one company, one operator. So, you know, we're in single family. Some people might choose to, you know, put a little bit into this multifamily deal. They put a little bit with us. And I don't think, you know, you should have, especially if you're a passive investor, you shouldn't have all your eggs in one basket.
Agreed.
It's one thing if you're a founder and you're an operator and you have control of your own destiny, then yeah, you can push everything in that direction. And that's how, you know, some of the richest people in the world have gotten there. It's not by diversification. Right. But if you're a passive investor, that's kind of what you're looking for is diversification, because anything can happen and you're not the one that's in control. So you should have, you know, an investment over here that's, you know, higher risk, higher reward. And then you have another chunk that's more stable and more consistent. So we are that more conservative investment. And if somebody wants to go invest in, you know, cryptocurrency or, you know, I had an investor who said, I'm just putting all my money into Tesla stock. This was, you know, a little while ago. And he's like, no, I've looked at the financials. And I mean, I invest in Tesla. That's great.
Yeah, me too.
But I'm not gonna put everything into it.
That's right.
So,
yeah. So now this being your second fund, right? This is, I think Fixated is your second fund?
Second real estate fund. Yeah.
Second real estate fund. Sorry. Yeah. Right. And then your other startup there. So how, are there any lessons that you've taken from those previous funds and with regards to investor relations? And have you applied those here? What are they, and have you applied them, or are you doing the same thing? What worked and what didn't work? Well, what are you doing now?
I think the difference is, you know, the first fund we were, I was really trying to save as much money as possible and do a lot of the stuff on spreadsheets, you know, can control everything without paying for software tools and some of the systems. And that made it more difficult with generating statements. It was a lot of like creation myself and doing everything there, a little bit more analog. Now, you know, we're raising a little bit more capital on this one than I did my first fund. We have more of a budget there. And so we're putting the systems in place. We've got, you know, our software tools to make it easier for us to generate reports. We've got all of our data points in the software instead of tracking it on spreadsheets. So I think it's more of what I'm doing in the background of operations from an LP standpoint. I mean, they'll see quicker statements. They'll, you know, see more data points from the deliverables that I'm sending out. But it's more of just on my end. Like I'm investing more in the tools that I have so that we can be more efficient from that standpoint.
Yeah. Efficiencies definitely play a factor into like customer service. I mean, for investor relations, I mean, if you're doing, if you're spending less time creating better reports, I'm with you, man. Our first fund, we're using Excel to create reports, and every quarter it was like manual. I mean, I would be up late at night. You know, my controller or my CFO were like texting at like 11 p.m. You know, trying to like finalize things, and you know, we got it done and we did well. But the amount of time we spent on that, I think, did take away from the amount of time we could spend doing other things. So I'm a huge fan of those. I'd love to know what systems you're using, like to do that, and how is that improving your ability to serve your clients?
Yeah, right now we're using Cashflow Portal. We're actually friends with the founder there, but that's we basically populate all of our fund docs into there, and then all of our investors will create an account on the platform. They can view all the docs. They can see our deck. They can see our performas. They can view everything in there. Obviously, we're going to start doing some webinars and calls and such, but all of the data is in this portal. You can go in when you're ready to sign the docs and everything. You don't have to get sent to DocuSign or whatever. It's all within the portal. You can just do it all cleanly, and then it stores all of that data securely for us. And then directly through there, you can actually link your bank and make your capital contribution through there. So it's all in one spot. The investor doesn't, they create one account, and that's where they can get set up. They can fund everything, and then that's where all of their statements and tax returns and everything will be housed long term. Obviously, we'll be sending out newsletters and emails, but they have one central spot where they can go and do everything. And see everything from inception. And so that makes it easy for us. And then separately, we can also put in our assets into there, and then it helps us with the data and calculating our returns and how the performance has been in the last quarter, and that helps us populate a statement a lot faster. So that we're not going out and running all of our formulas and then getting these numbers and then pulling them into some outside spreadsheet and then making it look pretty and sending it out. It's all kind of housed together. So that's really helped. We haven't launched it yet, but we've obviously been setting up these tools. So
we use a similar tool as well, and it's been really, really helpful. And one of the things that I think is overlooked, I think with people on our side, is how often investors might ask like, hey, I lost my K1, or can you resend that? And then you have to go through and kind of see like where it is and resend it, or they say they didn't receive it, and you have no sort of tool to understand if they got it or not. So all of that aftermath, you can avoid that, right? Oh, yeah, just reset your login password. It may be that, but the system does that for you.
And it keeps it all secure, so we don't have to deal with, social security numbers and things like that. So that makes it, a lot cleaner.
I love that. It's just definitely the way to go. Lesson learned for me as well. It took me a few years to learn that lesson, but it was there. All right. So how about with regards to like your sales pitch? And I hate saying it that way, but when you sit with an investor, it's your first meeting, you're like, hey, here's the deal, here's the project, here's your expected returns, et cetera. Have you changed sort of your approach on that part of your efforts?
Yeah. I mean, I think I've said before, first you invest with the people and then you invest in the project. And I think we've put together a really solid team. So, I've bought in a lot of properties across 13 or 14 states now. So I've done a lot of remote acquisitions. I have a lot of a pretty solid portfolio of properties. I haven't done as many flips. I've done a number of flips, but I haven't done as many as my partners. But I've done a lot of rehab projects because I've been building a portfolio. My two partners, Tarl Yarber, he did over 650 flips and is the systems guy. And he did that in Seattle, Tacoma. Mason Krell is our third partner, and he's more of our operations guy. So he's handling the contractors and organization with kind of the boots on the ground. He's done over 200 flips in the greater Phoenix area. So they both have the experience there. They've got the teams. They've set up the acquisitions. And so between us, we have kind of what we believe is a solid formula for both acquisitions, underwriting, and then performance on both the rehab side. But then another big factor that people don't talk about as much is the property management.
The management side.
We are not managing the properties. We don't want to be managing the properties remotely. We want to be working with the best property managers locally. So our job is to manage the property managers.
Right.
And so that's something I have a property management company myself, but that company only services sober living houses. So that's completely separate business. That company will not be involved in fixated capital, but I know what to look for. And I've also had other rentals, short-term rentals, long-term rentals, where I've gone through multiple property managers, and I've got quite a bit of experience in asking questions and kind of looking for different pain points that might be there.
Yeah, and then also having your own property management company, what works because you've literally invested in that. And so you can go back and even compare them to what you've created. And I did the same. I sold my property management company a few years ago that we had created here in San Diego. It did really well. It's still doing very, very well. But now when I interview, because I'm with you on that, I have a third party property management company manage our assets, and then I manage those property managers.
Yeah.
And that is a skill within itself because, as someone off the street, doctor or something who's trying to be an active real estate investor, even them, they would have a significant difficulty managing a property manager.
Totally.
And we actually did a podcast not too long ago with a property management company that I really like. And we talked about that. Like, how do we interact? Like, what questions am I asking? What are they asking? How do we make decisions together? At what point, where's the dividing line between they make a decision versus when I have to step in and make a decision?
Yeah.
And, and so that's a skill.
Yeah,
for sure. But I think it also adds to efficiencies, which is kind of, I think, one of the things I'm taking away from this conversation is that you guys have, with all of your experience, the three of you have learned lessons, hard and soft lessons, that you have been able to define places where you can become more efficient to be a better service provider, if you will. And so I'm taking notes mentally, and I'm going to watch this later and write some things down. But like, what systems, like if you were able to categorize what areas that you guys improved your efficiencies on, and what systems you put in place to do that, are you able to share some of that, like some of the key ones? I mean, obviously you guys have a massive business model, and but
yeah, I think the big thing has been the remote aspect of it, investing out of state, because like Charles, he set up a huge operation in Seattle, Tacoma. He was there. But after a while, he had the systems so strong and buttoned up that he didn't need to even go to the properties. He still did because he wanted to, but not all of them. And now we're applying those same systems to investing out of state. And what that means is, one, we do a trip there. So like, we need to know the neighborhoods and visit the market. And we meet with wholesalers, we meet with agents, we meet with contractors, we meet with property managers, and we ask around and we find out who we can trust and we trust, but then we verify with not just one, but we always get multiple. If we're looking for comps and we're getting a after repair value on a property, we have to have two. Yeah. Two separate sources give us the value there. And as we grow into that market, we'll be able to, run our own comps, which we do, but we're going to, get more efficient at it over time. But we're going to go to at least two seasoned experts in that market. And then as part of our underwriting, we rely heavily on pictures. A lot of people will go and like, let's go take a video and let's walk around. Well, that's great. We want the video too. But we want a video, we want a floor plan, and the floor plan can be, chicken scratches. We just want to know the general layout of it. And then with our pictures, it's a minimum of 100 pictures for a house. Some houses are up to 500 pictures.
Oh yeah.
And it starts out, it's like you're doing a video walkthrough, but with pictures. So you start out from the street, you're getting a picture of the front of the house. You're looking down the street one way, down the street the other way, across the street. We know what the street looks like. We know what the neighbors' houses look like. Are they fixed up? Is every house, struggling?
Like, and like, is it rehabbed? Or is it like
exactly? Yeah. And then you're going to walk the exterior. You're going to see every exterior wall. And with these pictures, we can zoom in because we can get high quality pictures now. So we're zooming in, we're looking at the siding, we're looking for cracks, we're looking for, materials, we're looking for, the eaves. Is there, signs of water and things like that. And then as we go through the house, we're taking pictures in the doorway. So we know, here's a picture of the doorway. We know we're approaching this. Standing in the doorway, there's a picture. Take a step in, left, center, right, walk in further, turn around, take a picture back of the doorway. So now if you're looking through these pictures one by one, you're doing a walkthrough of this property. And every bit of it, you can zoom in, you can see it all. Right. And so nothing should be missed through that.
Now, is this something that you're assigning to local agents or people like local property managers or asset managers, or is this something that you guys are physically doing yourselves when you fly into town?
Yeah, so we're using outside sources. Okay. So usually it's agents that we'll use. Sometimes if they're not the agent on the deal and they're getting a commission from it, because we have a few agents that we're consistently using and they'll just do it for us. But if not, we'll pay somebody $50 to go, who we've trained to be on to know how to do this types of pictures. And if it's not done right, we'll send them back, have them do it right. But we have examples of what we're looking for. Yeah. And so we send that to them and say, hey, like this doesn't need to be a crazy long thing. You just need to know the structure of it. But we have to have those pictures before we are at least bound to close. Yep. Like we can make a quick offer on a property with a contingency period. And then we have to get all of these things in place before we can move past our contingency. Okay. Yeah, that's great. So you've got now the acquisition systems. You've got the property management companies in place, and you guys know how to operate with them. Now, with regards to investors, you have your system Cashflow Pro, I think. Cashflow Portal.
Cashflow Portal. And so those sound like the four key systems that you guys were using to manage assets, to buy and manage assets out of state. Is there anything else I'm missing that's like a big one? I mean, obviously I know there's like nuances, but
I would say the other one is the construction. We have a number of different contractors that we can work with, and a lot of contractors, they're trying to move volume, especially when they're getting to know you. They're going to give you kind of larger estimates, and they're going to use their contract, and it's going to have a large line item for this area of it. But what we want to do is we want to break it down and be very specific, because like, all right, this is going to be the cabinets. All right, great. Does that include hardware? Does that include paint? Does that include this? Like, what is the quality of it? And who picks those finishes? And so we have a template for our construction project, and we itemize all of these things. It can be part of a larger line item. We can say, $15,000 for the bathroom or something, but it's going to be itemized and make sure that it includes everything. So that is really important to us. And then the contractor is going to sign our agreement, not theirs. So that we have that structure in place, and there's going to be checkpoints. So we're not going to just pay a bunch of money up front. Like we'll do an upfront payment to get them going, but then there's going to be a checkpoint before they get anything after that.
Do you guys have anybody on the ground locally that sort of checks in on those guys, or is that something that you guys do intermittently? What's the plan there?
Yeah, so we'll usually pay the same agent that goes to do all those pictures. We'll have them do that depending on the project, every week, every other week. So we'll have those pictures ongoing, and we have, our Dropbox with all of our documents, but we have a section for pictures where before pictures, this date pictures, this date pictures, and we can compare them side to side, and then we can hold the contractors accountable. So that's how we're able to do it remote without us physically being there, is having all of those verified, because we're not going to accept pictures from the contractor. Right. They're not going to show us the pictures they're going to show us the done section, and then there's going to be all of this over here that's incomplete. And so that's why we need to send out independent third party people. And so, that's what we do.
And so those agents, you pay them to do that. You pay them for their time. Are they also incentivized because they're going to be potentially the listing agent later, or is that something you keep separate?
Yeah. Oftentimes we'll have them as the listing agent. We have a few different agents in each market that like have kind of stepped up as being strong partners of ours. So, they're bringing us deals, and then they're also going to be our listing agents on the other side. So some of them, they're happy to go and get pictures, and sometimes we'll pay them to help us, with decision making on the finishes, because with the finishes, we might have a thought of like, hey, like we want white shaker cabinets and all these things, but in this market it might be more bold. We might want to have bright greens, or what sells in this market. And so especially as we're getting familiar with a new market, we're going to lean heavily into some of our more seasoned agents who know what sells and what the buyers are looking for, or renters. So,
and then with your contractors, when you have these contracts set up, are you guys buying materials? Do they buy the materials because you've got the preset value for like the bathroom, for example, the toilets and the cabinets and those things? Are they buying all that because you guys have the fixed number, or do you guys?
They're buying it, so that's included. The materials are included there. When we have the fixed number, we're using their numbers. They're still. We're not saying like, hey, this is all we have for this line item. We know what things cost because we've done it enough. So we're not going to get taken advantage of on that, but they're still bidding it, and we're getting, bids from several different contractors. But we just want to make sure that it includes every line item. So we're not getting a house back that doesn't have any appliances, or, things that are going to cost us a lot more money that, well, it wasn't on the contract. So
we had a contractor once, who, it was an apartment building. He gave us, it was, a long list of items that he bid. One of the things was windows. And I'm just pointing that one out because it was kind of funny, that, he gives us this bid, and I was like, oh, great price on the windows, similar to another competitor. And so I was like, great. So we signed up, we moved forward. Later it comes back. He goes, I only did windows for the first floor. And I was like, wow. I mean, so it was itemized, but we didn't talk about counts. Right. And so I would have known if the count was there, I would have said, oh, well, you're missing half the windows. Well, it's like missing like a third of the windows. But anyway, so that's great. I mean, these are all phenomenal lessons for investors who want to take an active part in doing what you guys are doing. It's also a great lesson for passive investors who can now look at you as a sponsor and have faith in the fact that you guys have really thought this through. And also having like, some empathy and compassion for you guys, because you're working so hard. It might look easy from the outside, but you guys are really working hard to make sure all of these things are done correctly, protecting the assets in which your investors are owning, and providing that phenomenal service. So I love it. I think you've touched on all the major parts of your business with the systems that you guys have in place to be successful. I know you guys are about to launch this fund. I know for a fact you guys are going to be successful, and I'm really excited for you. And you guys are like, I think you are younger than me, but you're experienced, and I think mentors come in different shapes and sizes, and there's like different ways you can accept lessons. And I've taken some lessons from even this chat. We've talked plenty of times on the phone, but there are things that I've taken from this that I'm going to definitely try to implement in my business. So I appreciate that. Thank you so much for your time. We're going to wrap here. Hope to have you again sometime on our podcast.
Absolutely.
And I look forward to, working with you too in the future.
Absolutely. Sounds good. Thanks for having me.
Thank you.